Hello and welcome to Markets Rewind. I'm Anupriya and I have a lot to watch out for over the next half hour. It's been a market where the real takeaway is that 8,300 has remained intact. The market rollovers, though below the 6-month average at this point, should probably start to pick up over the next 2 days. We'll be watching out for the big banking numbers that we had to endure during the day as well. And finally, the big Fed meet, which is underway tonight all the way on to tomorrow. So a lot to watch out for. How do the markets really fare out the day? Priyank's here with the day's report.
For a fourth consecutive day of decline as far as the markets are concerned, and in spite of that 2% crack yesterday, there's still no signs of any recovery, is what we saw as far as the benchmark index is concerned. Nifty, Sensex both seeing a little bit of a cut today. The Bank Nifty only saw that little bit of a gain because of a couple of the earnings that managed to lift the sentiment a little bit, and I'll get to that in a bit. But as far as the benchmark index is concerned, you can see the way the closing played out above that 8,300 mark, and which now is turning out to be an important support zone as far as the index is concerned. So the next couple of days as well, you'll be watching out for that 8,300 level, if the Nifty can hold on to it or not in this series. Having said that, among the losers, NMDC lost out, HDFC earnings impact coming in for that counter. ICICI Bank also was another major that lost out today. Among the gainers, PNB saw a set of earnings coming in that helped the counter see some bit of gains today. Stock closed in positive. BHL and HDFC Bank were a couple of the other names that saw a positive close as well. Now, in terms of the banking earnings, you're keeping a close watch on BOI. That stock was a little volatile. You also had Union Bank and Syndicate Bank. Syndicate Bank had a terrible number in terms of the way the quarter played out. Stock closed lower by almost 9% is what we saw on closing. Among the gainers, SpiceJet reported a fabulous set of numbers from the mid-cap space, helped to lift Jet Airways as well. Both those counters seeing a decent spike. And then you also had stocks like Ashok Leyland that saw some good momentum. Among the mid-cap losers, GSW Energy, JP Associates and Sun TV were a couple of the stocks that saw some bit of cuts coming in. JP Associate, ever since that downgrade came in from one of the rating agencies, has been extremely volatile and has been languishing. Among the volume movers, you had Marksans Pharma that saw a nice 9% move. Dish TV earnings impact coming in, a little bit of volume spurt as well. And JP Associates, once again, was another counter that saw some heavy volumes, and the stock saw that little bit of a decline coming in. All right, so that's as far as trade today was concerned. But for tomorrow, you have a couple of the earnings stocks to watch out for. Vedanta and Yes Bank from the index will be on the radar, and you're also keeping an eye out for GCPL, which will be in focus from the mid-cap space. Remember, it's expiry week, markets are getting a little volatile, and there aren't any, you haven't still seen any signs of recovery whatsoever. Turnover is inching up as one would expect, hitting around 4.5 lakh crores is what we saw in terms of trade today. The next couple of days, the level to watch out for, on the Nifty at least, will be 8,300.
All right, thanks for that, Priyank. Fed meeting is definitely the big trigger everyone's watching out for, and the China volatility as well. Adrian Mowat, who we spoke to exclusively today on the FII Street, believes that the China reaction is overdone and the September liftoff is more than likely.
Investors are very risk averse when it comes to emerging market equities. So we find interest positioning in emerging market equities at the lowest level that certainly I've experienced since doing the current job I have. Investors are comfortable to have risk in place in Japan and in Europe. Maybe their enthusiasm for the S&P is not as strong as it has been over the last couple of years, with that index somewhat range-bound. Interest in emerging markets is extremely low. I think there's a degree of overreaction to what's going on in the A-share market in China. This is a momentum retail market. It rose very dramatically from its lows in June last year. We've seen a correction. In the data that we saw for June, there was very little evidence that there was a move away from China towards India. What we've seen is clients have typically been underweight China for a protracted period of time, and certainly for the whole of this calendar year. I think the Indian economy will be accelerating. We think once the Fed moves and you don't see any outflows from emerging markets, then the central bank in India will be more comfortable to move policy rates down from 7.25%, and that will be a further help for the equity market.
That's the view coming in from Adrian Mowat. Let's connect with Mayuresh Joshi, fund manager at Angel Broking. Mayuresh, what are your thoughts into this expiry season, given the fact that we have a Fed meeting on the anvil as well? How would you play this market?
So clearly, Anupriya, I think the volatility will continue for some length of time, expiry notwithstanding. And clearly, I think it's a mix of both international and domestic factors that will create this volatility and ensure that the volatility stays. So how the Chinese markets react going forward on the domestic scene itself, what happens with the logjam in Parliament, any progress out there, and again corporate earnings expected to remain weak. So in my opinion, I think we are here to stay in a range from a short to medium term perspective, and that range still holds for us 8,000 to 8,500, 8,600.
8,500, 8,600 is what you're looking at. Mayuresh, we also speak at a time where we've got a host of earnings coming in as well today. We've got a lot of banking earnings. Let me first go across to Shraddha, who's standing by with the complete wrap of the earnings, and then get a sense from you on what are you thinking of these stocks as well. Shraddha, take us through the banking report card.
Well, if you look at some of the key parameters, first on the profitability front, all the PSU banks actually saw a decline in the net profit on a year-on-year basis led by higher provisioning, which restricted PAT growth for these banks. Punjab National Bank saw the net profit fall almost 49%, Union Bank down 22%, and Bank of India down by a whopping 84%. However, this compares to a loss of 56 crores that the bank posted in Q4. If you look at the asset quality, again in terms of gross NPAs, Punjab National Bank saw a small 6 basis points reduction coming in there at 6.47%. Bank of India saw a sharp uptick in its gross NPAs to 6.8%. The bank restructured close to 22 accounts worth 676 crores in Q1. Union Bank also saw a gross NPAs rise on a sequential basis to 5.5%. However, it's the lower slippages which actually cheered the markets. However, in terms of the absolute gross NPA numbers, if you look at that, Punjab National Bank saw a reduction of about 300 crores to a 25,400 crore number. Bank of India saw addition of close to 700 crores to its gross NPAs, and Union Bank of India that saw addition of close to 1100 crores or 8.5% to its gross NPAs on a sequential basis. And lastly, looking at the provisions, all the provisions did see a significant increase on a year-on-year basis. They declined sharply on a sequential basis, and that probably seems to indicate that the worst is over for some of these banks. Punjab National Bank provisions came in lower, almost 53%, while Bank of India and Union Bank both saw provisions fall close to 35%.
Mayuresh, there's been a lot of excitement in mid-caps as well. I want to first come to you on banking. How would you be positioned on a stock like PNB, who's got great valuation at this point? But the markets could cheer a 6.5% NPA number, but at 26,000 crores of outstanding bad loans, that's not something you want to be happy about a stock that you're owning.
Absolutely, and again I think this sheer stress in the economy still would continue for the next 2 quarters. I think the bank management are cognizant of the fact that the lending which has happened to the most sensitive sectors like iron and steel, real estate, sugar, infrastructure, all these sectors are still under stress, and it will take some time for them to recover. Again, I think the working capital constraints, apart from these sectors that a lot of companies are facing, if that cycle gets elongated, you're going to see further amount of credit costs increase onto the bank balance sheets. Couple that up with sluggish credit growth, and that's what the banks have been doing. They've been consciously reducing their credit growth over the past few weeks and months. Clearly, I think not having an addition in terms of stress assets going forward. So I'd like to see stability in earnings, Anupriya, I think, and that will take another 2 quarters, in my opinion, to say the least. And if that stability comes through, I think the valuations again extremely supportive. But clearly, I think they are plagued with these issues on how the asset quality will pan out. You're really not sure because the volatility in their numbers change quarter after quarter. Capital adequacy is still low for a lot of mid-cap PSU banks. And though valuations are supportive, we still prefer the private space rather than the public space at this point of time.
Hiral standing by with more on Maruti and how that counter performed. There was a bit of an impairment charge as well. Hiral, take us through the numbers for a stock that has been a darling of the auto pack.
In terms of where Maruti is concerned, the numbers have been above estimates in terms of where the top line as well as operation numbers are concerned. However, it's the profit numbers which have been slightly below estimates. If you see in terms of the total income, that has gone up by around 17% and profits have come up by around 57% versus an expectation of a growth of almost 67%. So that's where we are seeing a hit, and this is mainly because their other income has gone down by around 70 crores and come in at around 172 crores. Additionally, if you see, they have a one-time asset impairment charge of around 81 crores, which has hit the profit number as well. If this was not there, the margins would have improved further. Right now, the margin number has come in at 16.3% versus an estimate of 15.9%. Now, what has worked for the company is mainly the volume growth. Additionally, the cost reduction efforts as well as the lower sales promotion expenses have favored the margins as well. Volumes on the year-on-year basis have gone up by around 14%. However, on a sequential basis, they have seen a dip to the tune of around 2%. And in terms of where exports are concerned, we have seen a growth of around 22% on a year-on-year basis. And even domestic sales have aided the top line as well. In terms of where margins are concerned, it's mainly the lower expenses as well as the lower raw material prices that have aided margins, as the total raw material cost as a percentage of sales has come down to 61% versus a 67%. And even total expenses have reduced, and that has come in at 88.7% versus a 93%. And it's the other income which has been lower, on the back of which we have seen the profits missing estimates. So all in all, it has been a blockbuster number in terms of where operationally the numbers are concerned. Back to you.
That was Hiral speaking to us on the Maruti earnings today. Mayuresh, what is your own assessment of the stock near a record high? Earnings were a bit subdued, but looking at the run-up on the stock and a big S-Cross launch as well, how would you position yourself?
So clearly, I think the earnings were expected to be very robust, and Maruti did deliver. So in terms of volume growth, a 14% rise, the top line more or less in line with estimates. The operating margins were a factor of the yen depreciation playing out. And clearly, if you adjust the one-time impairment, the profitability came higher than what we had estimated at 1228 odd crores. Again, clearly, if you look at valuations and the financials, our take is that Maruti, in terms of earnings, in terms of pure EPS, it trades close to 220 rupees, which is perfectly priced, at least from an FY16 perspective. So how volume growth pans out in excess of 10% of the management is confident, and the product suite, I think that will be the differentiating factor. So I think investors who have bought the stock at lower levels should clearly hold on to that stock.
What about Hero Moto? Stock took a big beating in trade today as well. In the two-wheeler pack, would you say that this is now going to become an underdog because the performance for the auto ancillary has been a lot stronger than even the two-wheelers or the scooter makers?
So clearly, I think how the monsoons pan out, I think will be a determining factor on how the volume growth for the two-wheeler industry will pan out. And clearly, I think Hero's margins have been much lower than Bajaj Auto. Their valuation is much lower than Bajaj Auto. But clearly, our take is that there would be an uptick in realizations for this quarter at least. The margin should have a decent expansion. But again, I think valuation is causing a little bit of a headwind for Hero Moto, at least from an FY16 perspective. So I'll wait for corrections onto the stock, and Bajaj definitely has disappointed more or less with the kind of overseas growth, and specifically the growth in the African markets are causing a deterrent, not just for the top line, but again I think the bottom line is getting impacted because of the loss of market share, and again the adverse product mix that Bajaj Auto witnessed with entry-level vehicles causing a dent in terms of the realizations.
Mayuresh, before we shift gears onto earnings that will come out tomorrow, I want to focus on the aviation space. We understand Qatar is looking at Indigo and is in talks with Indigo. But meanwhile, we got SpiceJet numbers today as well, where they've turned into profitability as crude costs have come down dramatically, putting total costs down about 40% in the quarter gone by. How would you view the aviation sector?
Clearly, I think if you have a look at the worldwide companies that operate within this space, the free cash flows simply are not evident onto the balance sheets. And the balance sheet growth is not evident because the free cash flows do not come year after year and are not compounding. Secondly, I think the variable linking ETFs to how the movement of the stocks will be is a well-known phenomena. See, I think there is so much competition within this space itself that it is very difficult to make return ratios on a consistent basis. So in my opinion, I think it's a very difficult business model to understand, and I'll skip this industry generally on a fundamental basis.
All right, let's take a short break. On the other side, we talk about the FNOQs as well as the big earnings lined up for tomorrow. Keep it here on Market Street. Welcome back to Markets Rewind. I'm in conversation with Mayuresh Joshi of Angel Broking. I'm also being joined by Pranoy at this point. Vedanta reports earnings tomorrow as well. What are the expectations from the metal mining major?
Well, a weak quarter expected for Vedanta this time around, especially driven by the kind of underperformance that we've seen for Kane. Hindustan Zinc numbers are also already factored in. That has been a strong print. If I take you through the headline numbers of Vedanta, the profit is seen lower by around 60%. The expectation is of a number of around 550 odd crores. The total income is seen flattish at best marginally higher at around 17,400 crores. If you talk about the operational performance, the EBITDA is seen contracting by around 24 to 25%. The absolute number is estimated at around 4,300 crores, while a contraction in terms of margin is being factored into the tune of almost 9%. The margin number is expected at around 24.7% for the quarter. If I take you through the separate segments of the business, aluminium, the volumes are expected to grow 17%, 18% odd on a year-on-year basis. However, the EBITDA and realizations are expected to remain strained, basically on back of the fact that the kind of the downtick that we've seen as far as aluminum LME is concerned, down 10 to 11% on a year-on-year basis. Copper, however, volumes are expected to rise 36 to 37% on a year-on-year basis. A higher profitability is seen in the copper business. If you talk about the power business, that is again expected to be strained on back of lower volumes as well as realizations. Iron ore realizations, as usual, are likely to remain subdued. If you talk about the factors to watch going forward, obviously the timeline on the resumption as far as Goa mining is concerned and the commissioning of the 1.25 MTPA smelter will also be looked out. The commentary on that will be looked out for.
Mayuresh, anything positive to speak about the metal industry? Vedanta has shaved off 50% in its market value in recent times. Tightly in a bear grip market, you've got the cane overhang on it, you've got global commodity prices that are not supportive. Nothing seems to be going right for this counter. Would you call attractive valuation or just a safe bet to stay away?
So again, I think apart from valuations, I think the core business in terms of the commodity cycle actually going down, and the Chinese demand supply situation, the LME pricing, the LME inventory, all is pointing down towards commodity pricing staying at low level, whether that be iron ore, steel, zinc, lead, copper. So in that sense itself, I think with the kind of capex plans that Vedanta had in terms of expansion of its aluminium unit, and again I think the overhang related to the cane issue, I think that will keep on playing truant in terms of generating cash flows. So in our opinion, I think cash flows will be constrained for Vedanta for the better part of FY16, and though valuations are on the lower side, I think it does not make fundamental sense unless clarity emerges on all these issues to taken together. So I think I'll avoid Vedanta at least at this point of time.
I want to talk about private sector banks, and you know, Yes Bank did fairly well, okay in trade today, but you look over the last 6 months and none of the banking stocks have performed. West Bank is down about 10% for the year to date. Shraddha is standing by on what to expect from that private bank tomorrow in its earnings as well. Shraddha, you know, credit cost has actually been quite on the receding side over the last few months as well. Yields have started moving up. So what can we expect from Yes Bank?
Well, it is expected to be yet another strong quarter from Yes Bank, with net interest income seen growing at a strong 36%. Net profit, however, is seen growing at a slower 23% as operational expenses remain higher on account of investments in the retail franchisee. Net interest margins, they are expected to remain more or less stable on a sequential basis. If I talk about the loan book growth, that is expected to remain higher than the industry average, close to almost 30% on the back of the strong growth in retail banking. Deposit traction may also stay at close to 22% on a year-on-year basis, with the CASA proportion continuing to grow. Fee income trends again largely likely to be in line with the loan book growth, and asset quality, that is likely to remain broadly stable on a sequential basis. In terms of what are the most important key monitorables, what will be important is going to be that implementation of the retail strategy on both the asset as well as the liability side, and also the guidance on operating expenses and the branch rollout plans for Yes Bank. So overall, a strong quarter expected.
Mayuresh, how would you look at some of these niche, smaller scale banks? IndusInd's been a great outperformer, outperformed the Nifty, by the Bank Nifty at least by 10 odd percent, 20 odd percent over the last 6 months. Yes Bank has been in line with the Bank Nifty performance as well. So no fireworks there. How would you like differentiate amongst the smaller banks at this point?
So clearly, I think IndusInd has been posting stable set of numbers quarter after quarter. Their asset quality has held up. The credit growth has remained stable. And clearly, I think what is plaguing Yes Bank more or less to do is how their CASA ratio builds up. Apart from that, our own analysis suggests that the asset quality should be quite stable for the quarters to come. You will see a marginal uptick happening onto the CASA front, and clearly it's a very strong liability franchise. So capital adequacy is very strong. It is expanding its branch network, and that will ensure that the return ratios stay on track. So in my opinion, I think valuations are a tad bit too high for IndusInd. But yes, again, I think from a valuation comfort still looks better. So in my opinion, I think Yes Bank is something that I look at within the mid-cap private sector banking space.
Well, consumption is going to be a big story tomorrow as well to watch out for. You've got Dabur as well as Godrej coming out with earnings. I've got shares standing by with what we expect from Dabur because it's suddenly become quite a darling of the market as well. Share.
Right, so when you're looking at Dabur, a reasonably steady set of numbers, what is being expected. The company's revenues are expected to grow by almost 11%, a 20% jump as far as the company's profits are concerned. And also when you're looking at margins, an improvement of almost 150, 160 basis points is what is being expected. 3 or 4 major reasons as to why a steady quarter. The first one being when you're looking at volume growth, most analysts are expecting a volume growth of anywhere between 7% to 9%. So any number above 9% will definitely be a beat. The second major important thing is that the company has taken many initiatives as far as distribution is concerned. And analysts believe that these distribution initiatives will actually go ahead and help the volume trend as well. Apart from that, international business revenues coming in from there are expected to grow by 12% on a year-on-year basis. And the last major reason is that overall raw material costs, not just for Dabur, but even when you're looking at other companies such as Godrej, Hindustan Unilever, they've come down quite significantly. And the benefit of that lower raw material cost is expected to go ahead and help margins and profits. So these are the few reasons as to why a steady quarter is expected from Dabur.
Mayuresh, if HUL earnings were anything to go by, one shouldn't be too excited about, about consumption as a theory. We spoke exclusively to the HUL CEO as well, who continued to maintain the fact that, growth's not coming back anytime soon. Economy turnaround is not a light switch that can be turned on in a blink of an eyelid. So be prepared for tough times, at least for the next 6 months. Given that backdrop, would expensive consumption stocks be a good bet in a portfolio for safety keeps, or would you say that there are better opportunities in a tier 2 or a tier, in underlying mid caps as well?
So clearly, I think within the consumption theme itself, the underlying volume growth will be a key differentiator going forward. And as a lot of managements have been pointing out, the discretionary spending trend looks a little bit sluggish for the next 2 quarters. Having said that, the raw material price fall that we witnessed and the benign prices that are expected to stay for the next 2 to 3 quarters, to say the least, will have a positive impact on the gross margins of these companies. So clearly, I think the volume growth will be sluggish. The gross margin expansion would be very evident. But again, I think a lot of these companies are facing headwinds in terms of valuations. I think if you compare the long-term averages, many companies are trading at higher valuations. So I'll be very, very picky and choosy when it comes to the consumption space. But yes, I think within the larger universe, I think there are better stocks across themes that can be picked up at this point of time.
Give us some of those ideas, Mayuresh, before we let you go, because in the mid-cap space, and it's a very large and broad theme to question you on, but is there anything that you particularly like right now or particularly would like to avoid and would recommend to investors to stay away from?
So clearly, out of the numbers that we've seen so far within the NBFC space, LIC housing is something that we continue to prefer. The cost of funds is coming down, the yields are getting stable, the asset quality has been stable, and the earnings momentum should sustain. Bajaj Electrical is something that we continue to like even at this point of time. A lot of the legacy orders, specifically on the ANP book, are almost over. Larger margin orders are expected to come through. It's got a very decent order book. Earnings momentum expected to maintain, and the turnaround story would continue for Bajaj Electrical. And the EPC theme, as I've been mentioning time and again, I think is something that we like. So MPL Infra is something that I continue to like. It's got a decent order book. Inox Wind came out with good set of numbers in my opinion yesterday, and with second half capacity expansion coming on stream, the earnings momentum should continue in a significant manner over the next couple of years. So these are a few themes that we're probably liking into the market at this point of time.
Mayuresh Joshi, always a pleasure speaking to you. Thank you so much for all your time and patience as well. But that's a complete wrap on Markets Rewind. A lot of news continues. Tomorrow is all going to be about earnings yet again, and the big Fed meet which ends tomorrow night as well. Are we going to be geared up for a Fed liftoff? That's the question we'll leave you with on the Fed Countdown. Thank you so much for watching.